Good morning. It is Friday, August 24th, 2018. This is Kirk Spano from Fundamental Trends, Margin of Safety Investing, and Blue Mound Asset Management, writing at Seeking Alpha. Soon to be opening a Medium page, which will be a little bit broader view that I think you guys will like. The Medium page will have a lot to do with futuristic investing, sustainable investing, smart grid, alternative energy, technology, smart everything world, and will actually be a hub for a new investment letter that I'm launching that'll be cheaper and more focused, so you won't get everything that, say, Margin of Safety offers or the swing trading that's being introduced at Fundamental Trends this fall. But if you're looking specifically for a couple dozen really good futuristic investment ideas, the Medium page will be the blog, and then investorideals.com will be the service, and that'll be a pretty cheap service. That'll be like $99 a year the first year and $199 ongoing, and it won't be comprehensive, but it'll be focused, and maybe we'll hit a whole bunch of 10 baggers on that one, but it'll be for the patient investor looking at the future. I'm on vacation now. I am in Mountainboro, New Hampshire, at Camp Quinabarge. And like I was saying off air, if you're looking to get married in September or May during the camper off season, and you don't need a posh hotel, but you really like the rustic mountain lifestyle and having a lake, having just a beautiful setting. The first time I was here was for a wedding 9 years ago, and now that family has a deal where we get the place for a week at the end of summer before they get back into wedding season in September. Tell you what, great place to send your kids during the summer, and pretty great place to get married in September and May. So you might want to contact these guys. Camp Quinabarge up in New Hampshire. If you're in the Boston area or anywhere in the Northeast, might be just the right spot for you. And the kids programs are in such demand. They were actually able to add more to the facilities here this year. I walked in and they had a brand new kitchen and a brand new mess hall, and it's just amazing. If I had little kids, I'd probably be sending them here. So in any case, that's where I'm at. This is what I'm reading on vacation, the New Confessions of an Economic Hitman by John Perkins. If you don't know who John Perkins is, I suggest Googling him or checking him out over on YouTube and listening to what he has to say. It's really some pretty interesting stuff. Am I subscribed to this? Yeah, I'm subscribed already to TED. But the New Confessions of an Economic Hitman, I read the original version of this book back in 2004-5, right when it came out. And this has 15 new chapters in it, so it's a little extra information, touching up on the editing in the first part of the book, then 15 new chapters at the back end of the book. It really talks about how the United States and some of our allies have really, unfortunately, strong-armed and exploited, certain governments and countries in the world, but used it to, enrich ourselves and some of our executives. And, ultimately it's been good for America, but it will help you understand why some people are mad at us and why some people get irritated with the way we behave, the way we let our corporations act, how we deal with the world economically, financially, diplomatically, militarily. So I think that, if you can read this book, I think that you will get an understanding of at least the way some other people see us and why that's important. We take into account the macro view when we do our investing. So, I'll just open up here with, the core four that we do for folks who aren't familiar. We have a 4-step investment approach. We start with the macro and look for the big secular trends. That's why we are invested right now in oil and gas, because we think that there's a really good position trade over the next few years to make pretty good money in oil and gas investments. But ultimately, the long-term trends have to do with technology, has to do with alternative energy, a transition to a sustainable investment and financial and economic system. And I'm going to talk about something that probably blow your mind a little bit. I won't mention names, but there are corporations out there that get a rap as being anti-environment or somehow bad for the general population and just being profiteers. But I know for a fact that, and I've had some talks with some people here at this camp that are, pretty in the know, on big boards sorts of people who know that these corporations are looking at the sustainable wave that's coming, and they understand that they're not going to be able to stop the direction that things are going. So when I talk about alternative energy and smart grid and different technology trends, the idea that those are incompatible with capitalism and with development of an economic system that helps us all live better is just wrong. We need to understand that some of the old industries are going to go away or change dramatically, and we want to get in on that change because the direction that they're moving to can be not only very good for humanity, but very profitable to the investors and those who would take part. As members and subscribers and readers know, I talk all the time about businesses that you can get into, not just investments you can make, but businesses that you can be involved in or maybe stoke the interest of your kids in, that probably over the next 30 years, 40 years are going to be very profitable and make people a lot of money and change the world for the better. And that's really what we want. We want to see a better world. Here at Camp Quinbarge, they're very environmentally driven, and that's where I am. I just talked about that a second ago. But corporations that move in that direction with the big trend rather than fighting it are probably going to do the best. And that's where we start. So we're looking at the big trends. We want to know what the governments and central banks are involved with. We want to know the fundamentals of a company, where companies have a sustainable advantage or they have a lead or first mover advantage. Then ultimately we want to use the technicals and the quantitative data to help us know when to enter and exit stocks. And I'm a position trader primarily because I'm a registered investment advisor. Most of my trades are longer term because regulators prefer that, and they will give you less grief during down periods in the market when people complain, because people complain when the market goes down, even if there's no reason to complain other than, hey, something's not going my way, so I complain. But regulators don't like the swing trading, and they completely hate the day trading. So as a regulated guy, I'm primarily doing position trading. Now, members and subscribers know I also swing trade, but that's for select accounts, for people who understand that swing trading is a little bit more active, a little bit more volatile, requires more attention. And our swing trades that we've done have been very successful, the ones that I've exposed members of Margin of Safety and Fundamental Trends to. And they don't get all of my swing trades because I just think some of them are too hard to follow for the casual investor, for the person who wants to work 4 or 5 hours a week on their portfolio by reading a few articles and then setting limit orders on the weekend. But the people who do follow the swing trades, who keep up with the daily gyrations in the market, understand that as we get to target prices, we sell or we buy. Those have been pretty wildly successful. The best one was still when I called the spike in volatility back in January and February. And, we had people making hundreds of percent on that trade. Granted, it's only a few percent of your portfolio, but if you've got 5% of your portfolio and something that doubles, you got 5% that just fell to your bottom line for the year. Those are nice trades. I'm going to talk about volatility here today. So the volatility trade people have been asking me about, is it coming back? And I will tell you that I think eventually we do get a volatility trade. I'll talk about that in just a second. For those of you who follow, this is my portfolio right here. So I'm just going to flip that up there. You can go ahead, take a look at it. Some of these are buys right now. Some of them are not buys. Some of them are holds. And you know that we did just trim. There's an article coming out on Seeking Alpha today that says take profits on Exact Sciences. So, and I give my rationale for why, and we touch on it down here. But, you know, the VIX trade, I just want to throw this up here because people have been asking about it. We found this spot down here to buy, and then we got that spike, and now VIX has been coming down. And you have to remember, one, there's deterioration in this index because it's an ETF. So when it rolls over, it naturally is getting beat up. So if we take a look at the actual index, which I believe on Yahoo will be this, what we're going to look for is a VIX that gets under 10. And we haven't quite got down there again yet. So here's the, let's just look at the 2-year. So the VIX got under 10 here, and that was our trigger. So in here, when VIX was under 10, was where you wanted to buy the ETF. Now it's at 12 right now, but that means it can still go down another 20% before it really is a buy. So 10 is the magic number. If we can get in at around 10, you know, and some event happens, you know, look, it drifted, but now it's over here. So if it drifts a while, expect that. I don't know that I expect this trade to happen again this year. Now it could, you know, we could have a heck of a rally and then have a VIX down under 10 and want to buy it. If that happens, it happens. I don't think it's going to happen this year. I think it's probably more like next year. But we'll keep an eye on it. But if we do get a VIX number of below 10, that's when you want to start buying the VIX ETF calls like we did last time. All right. So I promised we talk about oil, and I have obviously gotten known for talking about oil. And I think this is a great headline. U.S. oil data has markets confused. And I think that's true. HFIR over on Seeking Alpha wrote an article about how the markets were not really confused, but just didn't believe in the oil trade, having a hard time getting on board. And I think that's true. I think until the oil markets start to rally and people start to get FOMO and that fear of missing out, I think that you're going to have a choppy oil market. But I think that this news, oops, that's not it. Where'd it go? I had there you go. This news. Seeking Alpha is pretty good for this stuff. I tell you, I like these little blurb articles they do with a link. So oil prices move higher as Iran supply issue looms. And the oil supply issue from Iran I talked about in the last couple articles. We're already 500,000 barrels per day down on Iranian oil, and they're saying that that's actually up to $700,000 barrels per day lost from Iran. So, you know, the original estimates were 300,000 to 1 million barrels per day being lost from Iran, and now it's looking like it's going to be more than 1 million barrels per day of Iranian oil supply that we lose. So, you know, Saudi Arabia is going to make that up in the short term, but probably not all of it. And, you know, Saudi Arabia actually just proposed in OPEC that if one member can't meet their quota or their limit, that other members can pick it up. Well, Iran didn't like that at all. You know, so they looked at that as a direct attack by Saudi Arabia on their oil exports, and it was. So Saudi Arabia and Iran continue to have their proxy fights. They continue to do their strong arm negotiating through OPEC. Iran continues to put pressure on Saudi Arabia by having troops in Syria, Iraq, and Yemen. And ultimately, as I've talked about, I think that there is a flashpoint. I just don't see that there is any room for them to negotiate because neither side wants to. And that's important to know, is neither side wants to negotiate. So the Iranians would love to get delays on pressure being put on them, but they have no interest in not putting pressure on others. So whether it's military or economic or through terrorism proxies, Iran just isn't backing off. They're continuing to build missiles. There's been several instances, investigations have found that they have in fact continued their nuclear program during periods when they said they didn't. This idea that this Iran issue, this confrontation with Iran is just going to not happen, or that it's all going to settle down and be peaceful, I just think is naive. And a lot of it's ideologically driven by people who just don't want to see the conflict. But it's coming. And I've been talking about it for a year and a half, almost 2 years now. And everything keeps pointing in that direction. Iran and Saudi Arabia keep moving in the direction of more conflict, not less. And as I have stated to subscribers, and I'll say it right now, I think September, October, November, you potentially see military conflict finally in the Middle East that we weren't expecting. Things like Israel attacking Iranian forces in Syria, the United States attacking Iranian forces in Iraq, and Saudi Arabia stepping up their pressure on Yemen, which is Iranian proxies, more or less. So oil has the possibility of spiking up higher in the short term. We could see 80, 90, $100 barrel a day oil, barrel oil quickly, by 2, 3, 4 months from now. So keep an eye on that. There's not much downside in oil because they are controlling the supply and demand. We went over that chart last week. So if you want to see more on the oil, take a look at last week's video. There's almost no reason to believe that oil is going to have a sustained down period anytime soon. Can it be choppy and in a range from like $65, $66 a barrel up to 80-ish a barrel? Yeah, it could be in that range for a very long time. What I'm saying is that presents very low risk for our oil stocks because they have hedged at much higher prices and they already are profitable and cash flow positive again, although they're pumping that money into, more development, which, your traders like, oh my God, they spent money. Well, yeah, they're development companies. That's what they're going to do. They're not borrowing anymore. So imagine these companies are spending out of cash flow rather than borrowing. They're going to get their margin on every barrel. So, that's good for them. If Iran's oil is off the market for a few years, which is what is probably going to happen, that's more oil in the market from Saudi Arabia and the United States in particular, a couple barrels from Russia, but they really don't have much spare capacity. The spare capacity is in Saudi Arabia and the United States. The United States will have more pipes in the Permian Basin by next year, and we'll have a surplus of pipes in 2020. So that means that the Permian Basin is going to get developed like nobody's business. There's going to be drill, baby, drill going in 2019 and 2020. So these oil stocks that we're in that are Permian linked are going to do really, really well the next few years. And I strongly encourage you to get involved in those because, they've just started to move off that technical bottom that I identified a week ago that others have picked up on. And they're already moving up again. And I think this might be the breakout. We'll see if this is the breakout, but I think this is a chance to be the breakout. So I did talk about last week how the oil and oil stocks are spring loaded. And that was picked up by Jeff Miller. So if you're not reading Jeff Miller, here's a guy that you should read every week. His Wayne the Week Ahead article every single week, read that one. This is just one of the best summaries out there. He has a structure that he goes back to over and over again. He covers the weekly developments. He takes a look forward. Somewhere in here he mentions me again. So he's picked me up like 5 times in the past year. he's got me on oil stocks, at or near the bottom of a trading range. And we have strong intermediate term outlook for oil stocks. So, and then here's a chart we went over where we pointed out that supply is lower than demand. Will supply go above demand? I don't think so. I don't think supply is above demand until sometime in the 2020s. I think they can manage it between now and then. I think the pressure in Iran is a big deal. I think the fact that we're adding 1 million or 2 million barrels a day of demand until the EVs come on is a big deal. These are just slow-moving trains, and people who expect big changes quickly are wrong to believe that. Those are narratives that the traders put out there. If you're not a swing trader and understand what you're doing, just avoid those narratives because they're wrong. All right, so today I put out an article on exact sciences. We're going to get to the Fed. Okay, let's do the Fed now. We'll do exact sciences in a minute. It's interesting that you've got Bullard saying that the Fed is near the neutral rate on interest rates, and then you have this guy who's a very Austrian-based, Austrian economist, compelling case for more rate hikes. So I disagree with that. I think that Bullard is right, and I think Kashkari is right. I think that we should stop raising interest rates. I think we should stop tightening and winding down the Fed balance sheet. I think we should refinance the Fed balance sheet, probably just issue a special interest bond, give people federal income tax free on a 3% 30-year bond and wipe out the Fed balance sheet and just pay it off over 30 years like a mortgage. There's got to be something they can do with Treasury. I'm not sure exactly how the legalities work there, but winding down the Fed balance sheet by buying back in debt, tightening up the liquidity markets, it's just a bad idea. It's going to cause a problem in the not too distant future. I think by next year or the year after, I am the hashtag crash 2020. If they stay on the path that they're on, they keep tightening, crash 2020. I'll tell you right now, liquidity is vital to keep this expansion going, and it's going to be vital for a very, very, very long time because the demographics are against us. The accumulated debt are against us. We need to refinance all the debt over and over again. We should be doing longer-term bonds instead of shorter-term bonds. We need to refinance this debt cheaply and understand that the deflationary pressure of demographics is going to be with us for 20, 30, 40 years maybe. This is not an Austrian cycle where we're just going to pick up to higher growth rates. We are in the slow growth forever economy, and governments and central banks that don't realize that are going to have a problem. And eventually that will manifest in the way people see the world. So I pull up the American Association of Individual Investors Sentiment Survey here to let you know that right now, most people see the markets as about normal. I think that we should be gradually getting to that bearish side. I voted neutral again. I've been neutral for over a year. And the market continues to go up, and we've had investments that have done very well. But we're gradually going to see things go from neutral to bearish. When will people vote bearish? After things have gotten bad. So the bullish part of this equation went up in the last week. So we are exactly at the historical average for people seeing the markets as bullish. When this number gets into the middle 40s, that's usually been a signal that we are frothy and that there's going to be a sell-off. So along with that VIX number that we said needing to get down to around 10, we need this number to get up to around 45. And that's when we would turn bearish outright versus being neutral and selective. All right. So One thing that we can take profits on right now is Exact Sciences. This article will be up publicly and free any minute probably. But we do get these articles out to the members sooner than the general public because we want them to be able to get out at better prices. So I discuss why to take profit on Exact Sciences. The market rallied on the deal with Pfizer, and people are looking at this deal as very bullish. I don't look at it as very bullish. I see it as it's just another statement on the reality of Exact Sciences. And what is that? What is that reality? Well, the reality is that Exact Sciences growth curve on Cologuard flattened out. So it's still growing. It had a 70% growth rate year over year, but that's from small numbers, right? So the growth curve never curved. The growth line never curved upwards, right? It didn't go parabolic. It's very straight line. So they had to cut this deal with Pfizer in order to get to the revenue numbers that I had projected a couple of years ago. So I suggested that they can get to revenue of over $4 billion a year by 2022. And, they are not on that pace right now. And Wall Street is starting to see it. So I believe that we are going to see Exact Sciences have a very choppy period for the next couple of years. The Pfizer deal, like I said, it's not great. It's not terrible. And there was an interview with Jim Cramer that I thought was actually a very good interview, where Cramer basically said to Conroy, hey, the street doesn't believe you have the growth necessary to support the share price. Is that why you did the deal with Pfizer? Well, Conroy said absolutely no. But it's clear that the Pfizer deal is designed to accelerate short-term growth, right? Because it's a 4-year deal, but it comes at a price. So above the baselines, then for their sales revenue baselines, you see that the 1.2 billion for 2021 is way below where I was. I was up at over 2 billion at this point. So if they would do, and I do an example here, if Cologuard does $2 billion in annual revenue in 2021, which I do still think is probably low. I think with 600 or whatever, it's 625,000 calls a year Pfizer is going to do on behalf of Cologuard. Let's say revenue gets to $2 billion. They've set 1.2 billion as the baseline for where Pfizer starts getting a cut. They do 2 billion. That's an $800 million hunk of revenue. It's at a 70% margin, right? So you multiply 70% times the 800 million of additional revenue above the baseline, and then you give half of that to Pfizer. So if they do 2 billion in revenue, Exact is paying Pfizer $280 million, right? That's a huge hunk of money. So that was growth that they thought they were going to get without asking for a partnership. And I said a year ago, hey, if they don't get growth, they'll have to ask for a a partnership. I didn't know who it would be. Call it a Pfizer ship, huh? Should we call it a Pfizer ship? They're basically going to pay $250 million or more to Pfizer over the course of this contract, and it could be 300, 400, 500, 600 million dollars. That's money that was originally going to go to Exact Sciences that they're not going to get anymore. Okay, so how do they make that up? Well, their pipeline is going to help make that up. But let's understand, they need to get this revenue in, because once these people start taking Cologuard, they start doing it every third year, right? So, that they need to get that annuity stream of income going. They can't wait an extra 5 years for it to happen. So they are going to pay to make sure they get that income stream going, so they can continue developing other treatments in their, not treatments, but screens, genetic screens, so they can get those to market. Well, the liver cancer, the blood test for liver cancer, which I cover here, the blood test for liver cancer could add another $1 billion of revenue. So if Cologuard comes in at the lower end of the range, which is looking like it could be, that $1 billion of revenue from the liver test, if they do that, if it comes to fruition, which it looks like it will, just gets them back to the high end of the Cologuard range. So what do I still think about Exact Sciences share price? I still think the $100 per share is inevitable, but that could still be 3, 4, 5 years out. The range that I set on Cologuard shares a couple years ago was between $100 and $200 a share. And people say, well, how can you have such a wide range? And as we're seeing as this plays out, it's because in biotech, there's a wide range of potential outcomes. If they had actually gotten to the $6 billion in revenue, which I said was the high end, then $200 a share would have been realistic. But it looks like they're only going to get towards the $4 billion a year of annual revenue, and that's with the first big next product innovation off the pipeline. So, I don't think that this stock has triple and quadruple potential anymore from these share prices. Triple would be the outside, and I don't even know that I'm confident that it'll double anymore. And my criteria is I won't invest in something unless I think it will double with the potential to triple. And I don't think that Exact Sciences fits that mold anymore. I think people ought to be taking some profits, not overweight it. You want to keep a couple percent, but you don't really want to, be loaded up at 6, 7, 8% of this in a portfolio anymore. I don't own any of it right now. And as I talk about lower in the article, for me to buy Exact Sciences again, it would have to clearly be in the 40s. I think that there's a very good possibility it gets into the 40s. At under $50 a share, now it can double with the possibility of a triple or quadruple. That's my criteria. That's my margin of safety. I don't want to chase 20, 30, 40% moves. I want to chase 100, 200, and 300% moves. And they're out there. We only need a couple dozen of them, and we can do real well. We have a lot of people who are subscribed up 40, 50, 60% this year, and our oil trade hasn't even come all the way in yet. If that oil trade comes all the way in, we're going to have people that are up over 100% back-to-back years, and that's monumental. It's unusual. I can't promise that. It's unusual, but that's where we're at right now. And come 2019, 2020, I actually think the big money will be made on the short side at some point, but the oil spike is going to carry us until the short side emerges. So we'll see. We'll see how that goes. All right, you guys should start firing out questions. We don't have a lot out there. I'm going to talk a little bit about Jackson Hole. I actually really did. We need to keep an eye on sentiment, Exact Sciences. Somebody posted in the chat room this article from Zenith about semiconductors and XPoint. We're invested in both XPoint companies. We have Intel and we own Micron. I just loaded up on Micron and I caught it almost right. It was on the low day. I didn't catch the low price, but I caught the low day, so real close to the low price. And I intend to hold on to Micron as long as the stock market is not getting crushed, which I think we got a couple of quarters. There could be some major turbulence around the elections and the Iranian sanctions, but ultimately I do still think the S&P 500 gets over 3,000, and I think the semiconductors lead the way. They are the brains and the connections. They're the brains and the nervous system of the smart everything world. So these semiconductor companies are going to do pretty well. Micron, I think, is the best one based on price and what they really do. People like NVIDIA, but I think NVIDIA's had its run. I think it needs to come back for a while because the cryptocurrency mining is going to dramatically be reduced in coming years, not increased. I'll just tell you again, cryptocurrencies were a bubble, were a mania. Almost all of them are going to go to zero. And the mining of cryptocurrencies will disappear. And if we go to cryptocurrencies for certain types of online transactions, it'll be controlled by the banks and the transfer agents, the PayPals of the world. It's not going to be people mining it off of a computer that drains the grid of energy. So, wait for NVIDIA to come back and be priced below the price that video technology requires. Been talking to somebody here who's on a board of directors for a pretty big system, And here at camp, there's a little bit of networking that goes on here along with the fireside boozing at night. But ultimately, Medicare for all makes a lot of sense, and you guys should be reading Jeffrey Sachs. This is confirmed by a libertarian think tank. So it's not just that liberals want Medicare for all. It's that the libertarians are saying, look, it makes sense. And even the conservatives who are business friendly think it makes sense. Why is that? Because most of the money in healthcare is made because we don't really make it efficient, and we don't allow price controls, and we don't allow fairness, right? It doesn't make sense that somebody without insurance gets a higher rate from the hospital than somebody with insurance. No, there's so many inconsistencies in our system that basically putting everybody on Medicare, where 80% of your bill got paid through the government, kind of through the government. Remember, there's regions of Medicare around the country, and there's a contract with the insurance company to do the administration. So there's not this giant behemoth government entity that controls healthcare. There's basically a skeleton crew of Medicare people who oversee it, and then they contract out the services to insurance companies. So even though there's public oversight and guidelines with Medicare, it is still actually administered by private insurance companies. In Wisconsin, it's Blue Cross. So, just understand what you're talking about. If you say, well, Medicare is socialist, yeah, bullshit. So there you go. First bullshit of the session. Medicare is not socialist. It is a way to regulate, very similar to how utilities are regulated. So you get oversight from the government. You get standards that are set. Three things that Medicare for all would do is lead to standard rates for hospitals and doctors that are lower than private insurers. Drug prices would be lower because you get to negotiate them on a national scale and set rules that say something along the lines of, President Trump has said this, say something along the lines of, look, you can't charge Americans more than you charge Europeans, right? Everybody gets about the same price. And then third, there'd be massive administrative savings, because instead of having these companies set their own margins, you say, here's the contract, put it on a bid. And they do these contracts on a bid. So the companies make a fair amount of money, but they're not making the extra 5, 10, 15, 20 points that they're making now. And I have showed this chart over and over again, and I'm telling you, this is a company that's going to get crushed. The pharmaceutical companies are going to get crushed too. But this is the massive bear market in healthcare that we are getting closer to by the day. Because if there's a blue wave in November, which I think is incredibly likely, then this goes away. Look at this curve for United Healthcare. Let's go a little longer. What the heck? What happened right here? Obamacare. So everybody was afraid of Obamacare, and then anyway, so it dropped. Then it actually happened, and the way the system was set up just greased this for these guys. There is no way United Healthcare is worth $264 a share. I'm telling you, it's going down to around 100. It's going to get back into here. Might even get under 100. It's going to get somewhere in this line. See, point. This will be the new support zone, maybe around $80 a share. It's going to happen. And when it starts to happen, I'll get on board with the shorts. But we can take a look at all sorts of different securities. I don't know how Pfizer is doing in this time period. How'd Pfizer do? Yeah, so here you go. Since 2010, tripled. Yeah, that's kind of in line with the market, though. But really, a lot of the pharmaceuticals and the equipment makers and the pharmacy benefit managers, take a look at their charts. A lot of them have these massive runs. There's a massive bear market in healthcare stocks coming just because we have to regulate it. If we don't regulate it, the country goes broke as the baby boomers mature. Here's some other things from Jeffrey Sachs that's out there. I mean, I really think you should look this guy up, follow his blog. In fact, here, we'll be able to get back to his blog right here. Just go to jeffsachs.org, and, he has all of his articles up here. And they link out to where they get published. Real simple. And this guy is one of the top advisors to corporations and the IMF and the UN. You should at least understand what this guy is saying, even if you don't agree. So he talks a lot about sustainability, how we can have a sustainable economy without displacing people. I think that there's a lot to that. All right, so let's take a look at the questions today. Kirk, did you read Jeremy Grantham's white paper on climate change and the investment? I have not read it, but I am aware of it. So I will actually click that and open it. Jeremy Grantham is a legend, and he deserves to be. So I would take a look. Oh, so this just came out. So thank you for the link. Everybody should read this. This is the future of investing and the future of the world. They move together. We can make a lot of money saving the world. And that's probably a pretty good combination, right? Make money, do good things. That's what we all want. It's coming. Corporations are already moving in this direction. Paris Climate Agreement was, I think, a step in this direction, although it hasn't been terribly effective. It's moved the needle a little bit, but not as much as we need to. So eventually, you're going to see the coal industry get destroyed. And there's one very simple piece of legislation that could be passed that would wipe out coal. And that would be for the United States government to say, coal can no longer be exported from the United States. So we stopped exporting coal, and then we banned coal-fired power plants on like a 5-year schedule. That would wipe out the coal industry, be tremendously good for the atmosphere. We could keep our farting cows because I like to eat beef. But, of course, you'd have to have things that protect those people who lose their jobs. And there's just a major coal figure today who said, look, the way things are going right now, it's going to make the companies and the executives rich, but it's not going to help the regular people because the coal mines are actually getting more automated anyway. So what we need is a program that says to folks in the coal industry, hey, we will make sure that you don't lose your house, you can feed your kids, we're going to get you education for your kids, we're going to get you retraining, and during that 4 or 5 year transition period, we'll give you some sort of sub pay on top of unemployment, or we'll allow you to work part-time while you're, collecting unemployment. Some sort of program that helps them transition, right? Maybe become entrepreneurs, whatever it is. But we can't just take the jobs without helping the folks that are in the industries. And that's really where Hillary Clinton lost it. She should have told all the folks in Pennsylvania, Ohio, and elsewhere, hey, this industry is going to get destroyed and displaced, but we're going to take care of you. And this is how we're going to do it. And the Democrats missed that opportunity. Trump picked up on it and exploited it. He's not really doing anything for those folks, but as far as I can tell, because the future is still going to come. Might come a couple years later, but it's still going to come. So we should keep an eye on that because the future is the future. The big secular trend is towards a more sustainable economy, a more climate-friendly economy, and there's a lot of money to be made in that. And I'll tell you, the technology exists to save the planet already. We have to get a lot of this stuff to manufacturing scale so that it's affordable. That doesn't really take that long. It'll all come within about the next decade. So over the next decade, we're going to see a huge transition away from coal, eventually away from oil, and finally away from natural gas. Although, unless these small-sized nuclear reactors really become so efficient that they don't create nuclear waste and they can't melt down, which theoretically is possible, but we're not doing it yet, natural gas probably be around the rest of this century at least. All right, so any more questions? Sierra Wireless. Yeah, nice rally, right? Nice rally on Sierra Wireless. I like it. I'm excited because I think we're going to actually get done in under an hour today and I can go swimming. But, yeah, Sierra Wireless is a big deal. Oh man, moving at the speed of Wi-Fi. Pulled back a little bit after that rally, but I really like it. Sierra Wireless finally shifting into high gear. When Motley Fool jumps on my ideas 3, 4, 5, 6 months after I have them, or a year after that I've put it out there, then we're getting close to that FOMO stage where we're going to get a rally that everybody else jumps on. So when everybody else jumps on our stocks, creates that big rally, somewhere in there where the curve gets weird and sharp and steep, then we have to start thinking about where to sell. But we're not at FOMO yet. I mean, let's take a look at Sierra Wireless. It clearly can get up to a new high of 47. So we have a long way to go on this one. Kirk, I have a fresh chunk of money and a good portion going into oil and gas stocks. As of today, which do you think has the best return potential? I like Encana as the combination of return potential and safety because I think that they are the right size to be acquired. They're a $12 billion company. Royal Dutch Shell described them to a T when they said what they're looking to add to their portfolio. I have calls on this one. I think Royal Dutch Shell probably makes a bid for them. But, if you believe in a potential spike in oil prices, if you think that could happen, Continental Resources is not hedged. So if the price of oil gets into the 80s and 90s, they'll finally probably hedge at that point. But they can make a ton of money if the price of oil really does go up. So this is the one where if you want something more aggressive, I'd be looking at Continental Resources. I'd be looking at Pioneer Energy, which came back to us a little bit. See this little comeback from 201 to 176. That's not bad. I mean, it's not as good as when it was down here, right? But I'd say Encana, the combination of safety and upside potential double there. If you want to, bet on a spike in oil prices, calls on Continental, pretty good. Some investment firms downgraded AT&T and CenturyLink. Very, very simply, I would say most of the analysts stink. The fact that they downgraded them after they were way, way down should tell you that they're wrong, because they could have downgraded them a year or 2 years ago, right? And been right. Now they're downgrading them near these bottoms where they're chopping along on a bottom. CenturyLink's already started to turn around. They're wrong. 5G, network-based security. Think about that. What is network-based security? Well, who's best able to protect you from the hackers? It's the people who control the network. So AT&T, CenturyLink, Verizon, I would expect them to either buy or augment, buy a security firm or augment their security services. You're going to see a lot more network-based security, and the companies in security that don't get bought out are in trouble. The companies that do get bought out are going to get that bid and make some money. But I like AT&T, CenturyLink. I like Verizon. I like that whole sector. All beat up. They all pay dividends. 5G coming. They're all going to have their own streaming services to compete with Netflix. DirecTV now I love. I can't say anything bad about the telecoms at these prices. If they're 50% or 100% higher, I'd ignore them. But I like them at these prices. Going back to oil, USOU, when to buy versus when to sell. I already said I been buying it down here and lower. We've had a few days of rebound. I think USOU goes between 80 and 100. I'm looking to try to get out of it, start scaling out of this, mid 70s up to 90. And, if you're a subscriber, don't ask me questions that are on the board. Let's try to keep some of our stuff from going too public. Ask stuff that we're not posting, and don't ask stuff that we're posting. Kramer compared AMD to Intel, and said that AMD is better stock than Intel. Well, here's the thing. AMD does not have the resources that Intel has. Do they have upside? Sure, because if they take some market share, that moves their small little bottom line more than if Intel does. The thing with Intel is that they have the money to get into everything that's emerging, and that's what they're doing. They have programs for all the biggest secular trends, and some of those are going to hit. And they're going to crush some of their competition. And eventually, you know, the problem they have is that most semiconductors are oligopoly. There's not a lot of competition. So the government gives Intel a hard time when they crush somebody or try to buy somebody. But Intel's still the big daddy. If you are a dividend growth investor, Intel's a great stock. It's going to drift upwards, and you're going to collect a dividend. It has real growth, but I mean, is it going to grow as much as Micron? No, Micron's a smaller company with a much bigger growth potential, but they're also riskier. So you have to balance what it is you want. If you're 70 years old and you like a 3% dividend with a few percentage points of growth every year, Intel's a great stock. In fact, I think it's probably better than Apple at this point. I think Apple has had its run. And remember, I'm the guy that said buy Apple at 57. I think Apple's about done. Apple's gonna run into issues on manufacturing. People are gonna start pushing back on them. It's already happening. So, keep that in mind. Is MU Leap still a buy? Yeah, it's only up a few cents from what I said as a price. So I would try to get it on a down day. You might get a down day next week. And semiconductors move a lot. So just keep using the list. Stick to the list. Try to do a little bit better than the list. Yeah, I haven't looked at VCell yet. EWZ or EWZ? Are you looking at Brazil? Yeah, I don't know how I feel about Brazil right now. Brazil's an I don't know, right? I've gotten this trade. I've tied on this trade twice. Brazil's tough. Charlie Munger said some decisions are too hard, so we just move on. I think Brazil's too hard right now. If it came down here to an all-time low, yeah, down around 10, I'd say, yeah, let's take a look at it. I think what you really have to do with Brazil is go through their holdings, especially their top holdings, and really analyze each one individually. What is Vale really worth? Is Vale really a company that you want to have a lot of money in? I don't think I do. Petrobras, so I really want a lot of money in Petrobras? I don't think I do. Ambev, yeah, maybe I buy Ambev instead. So I don't know. The Brazilian banks, so I want a lot of money in the Brazilian banks? I don't think I do. So I wouldn't be buying Brazil. On MLPs, I think that the ones that you want are the natural gas heavy ones, not the oil heavy ones, because I think that the oil heavy ones are topping out right now. And you want companies that are structuring over towards the C Corp, because that is better from a tax efficiency standpoint within an IRA. And I know most people have their money in IRAs. The MLPs just aren't going to grow anymore because ultimately the oil pipes are going to empty out. And the market will anticipate that years and years ahead of time because oil is a depleting asset. So you have to try to figure out that depletion curve. And the problem is that we don't know when we're going to stop using oil. We're not going to stop in any of our lifetimes, but we do know that the demand curve is going to turn over. And we don't know if that's in 5 years or 10 years or 15 years or 20 years. And the market doesn't like uncertainty. So I try to stay away from things that could get suddenly punished because the market wakes up one day on a headline and doesn't like it anymore. Although I like Kinder Morgan a lot. Kinder Morgan isn't an MLP, and I know people are mad because they got kindered, but really Kinder Morgan didn't do anything that anybody else didn't do. All the other MLPs got crushed. Kinder Morgan just was a bigger company with more people in it, and they felt it more, and they decided to get vocal. But Kinder Morgan's probably the best structured company right now. They became a C Corp before anybody else. got rid of a lot of those covenants that were bad for the MLP holders. If you don't understand how covenants work and what the limited partners have to kick back to the general partners, you better understand those companies. Some of those companies have just horrible terms, and the general partners suck money out of those limited partnerships, which is why they're cyclical. There's just a wavy chart. So ultimately, yeah, if they pay you 6, 7, 8%, 10% income, you have to weigh that against the possibility that you could lose half of your principal, right? I like CTL. They just pulled back a little bit today or yesterday. I think I think CenturyLink is going to set a new all-time high in the next few years, and that's pretty high, right? That's way into the 40s, 50s. I think CenturyLink goes into the 50s at some point. I think AT&T does as well. These are easy stocks to invest in, I think. The downside is that you collect a dividend and you have a dead money stock, but you're still making 3, 4, 5%, right? On AT&T it's what, 5%, on CenturyLink it's 9%. If that's your downside to wait this out, I don't know, that's not such a bad downside, is it? And if I'm right about 5G and network-based security and new streaming services, these companies have a lot of room to go up. Think about what happened to Netflix. Netflix was first mover advantage, but now they're going to have competition from Disney, from AT&T. I think that Verizon might cut a deal with Sony. We'll see. Sony is going to have to decide how they want to handle things, but they just moved in the streaming service on their game side. So, that potentially is bad news for GameStop, which I'm also in. So I have to evaluate that over the next few weeks. Any thoughts on emerging markets? They are not emerging right now, but eventually we want to own them. Is CTL still a buy with the recent run-up? Just got that. Chesapeake. I think Chesapeake is going up to around 8. I will start scaling out of it when it gets to 6. But I do think it's going to what the heck? I don't think Chesapeake ever sees $30 again. But I think you take a look at this post-oil collapse period. Come on, chart update. I should be using this. This is my fault. I should be using this. So we're looking at Chesapeake Energy. This is the one where we sold the stock and we bought calls. And since we did that, right, and I talked about this on Forex Analytics. In this area, we were buying calls on Chesapeake. Look what it's done for us. Let's take a look at Chesapeake over the last 5 years. Can it get back up to these highs in the middle 20s towards 30? I don't think so. But this level here, this $8-ish level, which it sniffed a few times, I think it for sure gets to a right around there. Does it break through and go all the way up to 15, 16? Maybe. I don't know. It depends on the price of oil and gas. But 8-ish seems pretty certain, and there's a potential for middle teens. Look at this level here. So, like I said, I'll start scaling out because we'll be up hundreds of % on that call if it gets to 8-ish. And, bulls make money, bears make money, and pigs get slaughtered. So, make sure we're not pigs. Western Digital, I haven't even looked at it lately. I don't know. Enbridge is okay, but no. Not buying it. Tell you, I like Kinder Morgan. I do. Enbridge is good too, but I like Kinder Morgan. Just feeling it. There's no reason you can't own this. You pair it with Kinder Morgan, I think you'd be fine. Western Digital, WDC. Pair it both on the long side, that is, not short on one or the other. Yeah, we should really, with this price decline, because we started watching it in here, right? And now it's down here. It probably is really close to what I said that we should be looking at, isn't it? Yeah, we should review Western Digital. Which list are you referring to when you say use the list? Good. Are you a subscriber, Martin Wright? Are you a subscriber? If you're a subscriber, you know what list that we're using. Yeah, go check out all the Google Docs, the VSL docs. Whiting. Whiting is similar to yeah, well, go into this forum at Fundamental Trends and just click on the link for the very short list. And there's a link right to, man, we're covering over 200 stocks. Whiting Petroleum, similar to Continental, but Whiting has some assets that aren't all that good. Continental is a more focused play on oil prices, even though neither one of them really hedges. But I think that Continental has the better assets, right? So if we compare Whiting to Continental, you see that the market likes Continental better. Pretty much for the oh wow, look at that. The market likes Whiting better. In the last year, is that true? No. Over the last 3 years, it's Continental. Over the last year, I guess Whiting jumped up, huh? Yeah, I'm not. So Whiting has some assets in Colorado. I don't like any of those Rocky Mountain assets. They're hard to drill. They're expensive. They constantly disappoint on production numbers. So I'd prefer to have Continental, which is the Bakken and the Stack Scoop. All right. All right. I think we're done today. Let's go have a weekend. Yeah, 1 hour on the nose. This is the very first time. Well, not first time. First time in a long time that we've been done in an hour. So let's have a good time this weekend. Summer's coming to an end. We only got a few weeks left. Go out and do something fun. Say, tell somebody that you love them. Do something good. Do something healthy. And let's keep making money. Let's keep an eye on the prize. And let's understand that there are short-term, intermediate-term, and long-term things on the horizon. Short-term, we can generally just use as opportunities. Intermediate-term is the easiest one to invest in. Long-term, always be optimistic because, hey, if things don't get better long-term, what's the point, right? So be optimistic long-term. Then we just have to figure out our investment strategies between now and then. I will eventually take a look at VSEL. And we'll talk about we're going to talk about batteries and other things pretty extensively over the coming months. All right, take care.